Welcome to another week of tariffs being announced by Trump and the stock market reacting with fear, and we're seeing stocks taking a nosedive. And I want to share with you if I think it's a buying opportunity right now or not, as well as how do tariffs affect the stock market. And the best thing that you can look for in companies that you invest in to protect yourself from any negative effects of tariffs or really any kind of volatility and negative economic effects. So let's dive right in and let's talk about tariffs. Now, tariffs can have a significant impact on the stock market, and their effects can vary depending on the scope, implementation, and duration of the tariffs. That's important because we know Trump likes to use them as a negotiation tactic. So they're kind of more short-lived, but we don't know how long they can go on depending on the reaction from the other side. So here are some key things to consider with tariffs. This can increase costs, and I think you've heard of this. Tariffs are essentially taxes on imported goods, which can lead to higher costs for companies that rely on these imports. Companies may choose to absorb these costs, leading to lower profit margins, which probably not going to do that, right? They want to increase their profit margins, so they're most likely to pass them on to consumers, potentially resulting in reduced sales unless they have a really good product and service that has a wide moat and pricing power. The next thing is market volatility. Tariffs and just the announcement of them and implementation of tariffs can create uncertainty in the market, leading to increased volatility. Investors may react to news about tariffs by selling off stocks, which we're seeing now, causing the market dips. Tariffs can also impact earnings. They can directly affect corporate earnings. For example, a 5% increase in overall U.S. tariffs can reduce the S&P 500 earnings per share by around 1 to 2%. So if we slap a new 25% tariff, it can make a 5 to 10% difference in a company's earnings. Then we have sector-specific effects. Different sectors may be affected differently by tariffs. Industries with complex global supply chains, such as manufacturing, may be more vulnerable to negative impacts on tariffs. So if you hold a company like that in your portfolio, just be aware of what could happen and ensure that it's a high-quality company and that it holds something we're going to talk about in a little bit. Then there's retaliatory measures. Other countries may respond to tariffs with their own retaliatory measures, further impacting global trade and market stability. We see China doing this. Right now, there's just this big negotiation going on between the world, it seems like, with these tariffs, and it's creating a lot of stock volatility for you and I, but that always creates opportunity, right? So tariffs can be used as a policy tool to address the imbalances and encourage domestic manufacturing, and we see that with Trump. He's trying to bring more jobs to the U.S., and they can also introduce significant risks, though, and uncertainties for the stock market. So I thought it'd be good to look at how these tariffs have historically impacted the stock market, specifically with Trump's first term. And just keep in mind, all presidents hold tariffs, increase them, decrease them, but I think it's just getting a lot of limelight right now because it's dealing with Trump, and we just know how the media likes to react to him. And so, first of all, in 2018, there was the steel and aluminum tariffs that happened. And under the Trump administration, tariffs were imposed on steel and aluminum imports to protect domestic manufacturers. The immediate stock market response was mixed. Industrial and materials stocks saw temporary gains, but broader market indices wavered due to fears of higher costs and potential trade wars. Despite the initial volatility, the market eventually shrugged off the impact, and major indices, including the S&P 500, continued their upward trajectory in the following years. So that was an initial volatility that occurred, but it created increase in the stock market overall. Then in 2018 and 19, we had the U.S.-China trade war, and we're having one again now, so this one might be a little bit better to compare. But the U.S.-China trade war in 2018 and 19 saw both countries impose escalating tariffs on hundreds of billions of dollars worth of goods. The stock market reacted sharply, kind of seeing that now, with major indices experiencing heightened volatility. Investors grappled with uncertainty as trade negotiations dragged on, leading to periodic sell-offs. However, markets rebounded when negotiations signaled potential resolutions. So I think to keep in mind, these are things to compare with what's going on now and what to maybe expect. Is it's always the case where there's news headlines, there's lots of fear initially, and it creates volatility. It creates the declines in the stock market, and that creates opportunity though for us. And we've seen the result each time just be the stock market goes up, up, and up. Now, we can't say that's going to be a cut and paste every time, but because we saw those two examples with Trump in his first term, now with Trump in his second term, I think we can expect something similar. But that's where we need to keep our eyes on the news around tariffs and see, are these tariffs looking like they're going to last long term, or are there some negotiations that are happening that might create some resolutions? And then what happens after that? Stock market goes up because investors do not like uncertainty. So keep that in mind with what's going on right now. I'm treating it as this volatility that's happening. I'm creating it as a buying opportunity. I bought a little bit of stock today, which I'll talk about in a minute. And I think that's okay to nibble right now. I think the market is in a position where you add to those high quality companies in your portfolio little by little. I wouldn't dump your money in yet. I think with the volatility, we could see another 10 to 30% drop in certain companies and sectors, or market wide. You never know. That would be more of the opportunity where I would buy in heavily. Now, there is one thing. If your companies have this, you have nothing really to worry about. And I won't say nothing, because you need to, no company's perfect or protected against everything, but there's one thing that really helps a company survive volatility, especially with tariffs. That is impressive free cash flows. Now, Apple, for example, is a company that generates consistently substantial free cash flow with a recent figure of $108.81 billion. They're making over $100 billion of free cash flows. That's crazy to me. This allows the company, or any company with massive free cash flows, to invest in innovation, pay dividends, and buy back shares. Those three things you want to ensure a company is able to do regardless of volatility. So you want a company with free, strong cash flows, because if you do not, imagine a company that's not able to invest in innovation, or not able to pay its dividends, or buy back shares. We've seen what happens. Their stock price takes a nosedive. So these companies that have these strong free cash flows know that volatility are buying opportunities. That's how I see it. And another way to look at this, a lot of people like to value companies with the PE ratio, but I like the free cash flow yield. I think that's a better way to value a company. And right now, Apple's free cash flow yield is currently around 2.7%. Now, this metric indicates the company's ability to generate cash from its operations relative to its market value. A higher free cash flow yield generally suggests a company is generating ample cash, which can be used for dividends, share buybacks, or reinvestment in the business. So the higher the free cash flow yield usually indicates the better value for a company. The lower means it's probably more expensive. So it's kind of the opposite of the PE ratio. Now with Microsoft, they're generating $72.66 billion of free cash flow. That is significant as well, but their free cash flow yield is a little smaller at 2.3%. So you can almost look at it as Apple is the better value than Microsoft. But those are still good yields. I like to see free cash flow yields around 3.5% and above. To me, that is indicating that this company is at a good valuation. You're kind of getting that bargain, shall we say, a stock on sale. Now, with other companies we're going to look at, just for fun, Salesforce has a free cash flow yield of 4.09%, making it a top performer in its industry. Merck & Company boasts a free cash flow yield of 6.45%, highlighting its strong financial position. Adobe's free cash flow yield stands at 4.08%, reflecting its ability to generate cash from its operations. Qualcomm had a free cash flow yield of 7.14%, showcasing its robust cash generation capabilities. Amgen, their free cash flow yield is 6.11%, indicating its strong financial health. Caterpillar has a free cash flow yield of 5.37%, underscoring its ability to generate cash from its operations. Shell, their free cash flow yield is impressive at 19.59%. That is substantial, making it a standout in the energy sector. But I'm going to tell you in a minute some warnings on those extra high free cash flow yields. And then lastly, Unilever has free cash flow yield of 5.51%, reflecting its strong cash generation capabilities. So these companies are well positioned to navigate economic uncertainties and invest in growth opportunities due to their strong free cash flows, giving you less worry during times where tariffs are creating fear in the market. Now, regarding those very high free cash flow yields, sometimes it can be a red flag for investors, and here are some risks associated with that. It can mean underinvestment. Companies with high free cash flow yields might be underinvesting in their business. This can happen if management is focused on maximizing short-term cash flow at the expense of long-term growth. Over time, this can lead to a decline in the company's competitive position and future earnings potential. The other risk is financial distress. A high free cash flow yield can sometimes indicate that a company is in financial distress. For example, if a company's stock price has fallen significantly due to poor performance or market conditions, its free cash flow yield might appear artificially high, just like the PE ratio might be artificially low. This could be a sign that the company is struggling and may face challenges in the future. And don't mix that up with, oh, it's cheap. That could be a huge problem that you're not seeing. Another issue is one-time events. High free cash flow yields can also result from one-time events such as asset sales or temporary cost-cutting measures. These events can boost free cash flow in the short term, but may be substantial over the long term. And then market mispricing. In some cases, a high free cash flow yield might indicate that the market is mispricing the company's stock. This could be due to a lack of investor confidence or negative sentiment, which might not be justified by the company's fundamentals. So again, free cash flow yield is your best way to protect you against volatility and this tariff fear that we're dealing with right now. Your company will weather the storm and it'll be on the other end and then keep generating you profits and gains. And with the market right now, as I stated, here's my portfolio I want to show you as I talk about this. I think we are entering into nibbling territory. That's what I'm going to call it. So I think this is an opportunity to start buying little amounts of those high quality companies that you want to add to. In my portfolio, what I added today was some Microsoft. So of course, Microsoft, the last few times you saw it was in the green over 60%, but because I'm buying at a higher cost basis now, it lowered that down, but long term, that's going to position me for some awesome profits. Now, with these companies, they all have strong free cash flows and free cash flow yields. You have Microsoft, Amazon, ASML, Health Equity, Union Pacific, S&P Global, and then you have Vici. Now, they measure in a different way, but they all have good free cash flows. And for me, that means I can sleep at night. I think this portfolio will weather any storm. So any dips, especially significant dips, I'm going to be buying. So again, I'm going to be buying small amounts of my positions with this market drop that we're experiencing now. But shall the market go down another 10 to 30%, that is when I'm going to be buying more heavily. And with each 10%, it would be heavier and heavier. I do have a cash position built up. I think you should always have between 5 to 10% of cash on the side to take advantage of those opportunities. And that's what I'm starting to do now. So let me know if you think that there is any other factors that are super important to protect your portfolio against volatility. Again, my number one thing is the free cash flows, utilizing the free cash flow yield as a measurement. And of course, these high quality companies are going to be holding that true. But be warned, there can be these high free cash flow yields that deceive you, and it can mean there's an issue with the company. So you got to really look into it as an investor. So let me know what companies you are buying during this dip. Are you going all in because you think there's going to be a quick turnaround, or do you think there's going to be a bigger dip or even market crash in the future and you're kind of holding off right now? I'm nibbling, like I said, I think it's nibbling time, but it'll be kind of load the boat when those stocks drop another 10%, and then of course 20 and 30, I'll just buy more and more as it goes down. So with that said, I'm anxious to hear what you're buying. Again, I bought Microsoft. Tomorrow, over the next week, I might buy some Amazon and I might add a new position. I was very close to adding it today, but I am staying patient because there's a price target I want to get in this company in, but I'll be sure to let you guys know right away if I do. So with that said, happy investing. Don't be fearful. Take advantage of the opportunities. We'll see you next time on Mark Arnold's Finance.